Hey everyone, Assalamu alaikum. I'm your teacher Bilal Kurd, and in today's lesson, we are going to solve a question related to investment appraisal. The past paper that I'm going to use is going to be of the attempt March 2023, paper 32. And the questions that we are going to solve are going to be question 4, part A, in which we have been asked to calculate the ARR, and part B that asks us evaluate whether FWB should invest in enterprise resource planning, and the question is of 12 marks. So I would want that you go through this particular information from here till here, pause this video so that we can continue from the parts that are relevant to us. Alright, so I hope that you've gone through the case information. Let's review the paragraph that is of special emphasis for the question number 4. A tip that I would like to give to all my students, that in paper 3 case study you are given headings, and pretty much the headings are relevant for a certain question type. So it's always useful if you could perhaps make a point that okay fine, this is going to be relevant for question number 4. Okay, so let's first solve the calculation element, and then let's go through the case and try to extract as much points as we can so that we are able to answer the 12-mark question as well. So the data that you need in order to do the ARR calculation is that you are given the capital cost of 650,000. That is basically your cash outflow. The residual value is basically $0, and here you can see that you are given cash flows of the 5 years. Now when you are calculating ARR, the formula is that you first calculate the annual profit, then you calculate the average investment, and then you multiply it by 100, and the answer is likely to come in percentage. Remember that it's very important to mention the unit of measurement. So if let's say you are calculating ARR, percentages will be important. If you are calculating NPV, perhaps a dollar sign or million if appropriate would be necessary to include, because it might result in a loss of marks as well. So in order to solve ARR, there are basically 4 steps that I always teach my students. So step number 1, you can also follow any other step that you want as well. Step number 1 would be to calculate the profit for the 5 years. And how do you calculate profit? That basically is revenues minus cost, or inflows minus outflows. So the first step would involve that you're going to add all of these cash flows, the inflows. That's going to give you an amount of 900. So 150 plus 175 plus 175 plus 200 plus 200. Then you're going to subtract your initial capital investment, because that's the only outflow and that is mentioned here. And you get a total profit of 250,000. Now this profit is basically for 5 years, right? But in the formula for ARR, it's asking you annual profit, or in other words, average profit. So your step 2 would be to break this particular profit down to an annual basis. And how you're going to do that? It's basically calculating the average of something. So you have sum of terms upon number of terms. So the sum of terms is basically 250,000, and the number of terms is basically the number of years, and that is 5. So you get the average profit of 50,000. So you already have the numerator with you. Now let's talk about the denominator, the average investment. In order to calculate the average investment, what you're going to do is you're going to first add the investment and the residual value, and then you're going to divide it by 2. As in this case, you can clearly see that the residual value is 0. No problem. But we have the investment of 650,000. So it's going to be 650 plus 0 divided by 2. And you're going to get the average investment, that's going to be 325,000. So this is your average investment. So you already had the numerator before. Now you've obtained the denominator as well. And voila, what you can do is you can calculate the ARR by dividing these 2 terms. And you're going to get an answer of 15.38%. Now this basically tells you that if you were to invest in this project, you're going to get the profit. ARR is basically the rate of return. You're going to get the profit from this project on an annual basis that's going to be 15.38% of your capital cost. So if I were to present it, this would be your first step. You calculated the entire profit. This is going to be your next step where you calculated the average profit. If the number of years are 6, you divide it by 6. If the number of years are 8, you divide it by 8. Alright, just like we do it with any average. Then you moved forward and calculated the average investment. Here you have the answer. And then finally, you calculated the ARR. So these are the first steps that I teach my students. You can follow these steps or you can come up with your own method as well. Remember to show the formula and mention your workings as well. So even if you do not land up with the right answer, you're going to get marks for the formula and the workings if they were correct as well. Okay, so let's move on towards some qualitative discussion. I'm going to talk about ARR and investment appraisal in detail as well, but let's dissect the case information in the best manner possible. So we have this question. Okay, so it says, Makina is reviewing operational efficiency at FWB. She is concerned with the amount of waste products, including inventory, that has deteriorated, that must be disposed of. However, there have also been occasions when vans have had insufficient inventory to meet demand. Now, the question is relating to ERP. And ERP, a database, a way of re-engineering business processes. So this database is likely to help you coordinate all the departments on the same page. And if you were to search for the benefits, ERP does talk about how it helps in implementing just in time. So the problem that you're facing of inventory can be solved with the ERP installation. Why? Because ERP is going to facilitate you with the implementation of just-in-time inventory control. And why would this be important? Because you can clearly see that the concern that one of the directors have is about improving operational efficiency. That means inputs are less as compared to the productive outputs. So here you already have a benefit, a qualitative comment. Alright, so let's move on. FWB has many suppliers and coordinating deliveries is difficult. Now, obviously, if you were to evaluate this point that fine, ERP would help in the implementation of JIT because automatic orders of inventory can be passed on to suppliers and there would not be any miscommunication, which is a very strong barrier when it comes to JIT. You need strong communication systems, XYZ, and you built a chain of analysis. But if you were to evaluate this point, you can mention that ERP might not be able to help fully. Why? Because it much depends upon the reliability of suppliers. Reliability of suppliers is something that you cannot help yourself with. So if you have many suppliers and let's say they are very distant from the business and it's difficult to coordinate amongst them, then ERP may be of limited benefit. So there you have an evaluative comment as well. So as you're dissecting the case information, try to make these points, write them with a pencil and brainstorm so that even if you have to read again, you just go through your points and you can save a lot of time. 1 hour 45 minutes, do not think that there would be plenty. You may have a bottleneck of time as well in paper 3. So let's move on. Makina is considering investing in ERP. An ERP supplier has provided FWB with an estimate projected net cost savings for a system with an initial capital cost of 650,000. The supplier advised Makina that ERP system would have a residual capital value XYZ, XYZ, XYZ. Now, I always tell my students that whenever you have a question on investment appraisal, there are always certain things that you can keep in mind. And those are the things that can be included in nearly every answer. Trust me, those are the things that nearly can be included in every answer. All you need to do is you just need to change the context because the case study will be different. Now, the first thing that I always advise is to basically check the span of investment or the span of returns, in other words. Here in this case, you can clearly see that the project goes for 5 years. And I would also want you to calculate the payback period as well. The answer for payback would be 3 years and 9 months. So the span of the project is for 5 years. And I always ask my students that if I were to ask you if they are in A2, if I were to ask you where would you be next year, and in a matter of seconds they answer me, I'll be in a university. But as soon as I start adding those years, where will you be after like 5 years or 10 years or 15 years? So forecasting gets difficult the more you go in the future. Do you get my point? Because of increased uncertainty. So perhaps your estimate of what you're going to get as cost savings in the first year or the second year or the third year may be true to some extent. But if you note in this particular table, the greatest cash flows have been accounted for and recorded in the later years. And the later years are likely to be less accurate. Since the later years are likely to be less accurate, therefore, the calculations of ARR that you've done or the payback period that you've calculated is from this data as well. And if the data itself is inaccurate, how can your ARR or your payback be completely relied upon? So there you go. You have an evaluative comment right there and then. You're questioning the validity of data used in the assessment of such techniques. So first things first, you're going to check the span. The next thing that I always advise my students is to check the source of data. Now this entire table, if you focus on the table, this entire table has been, the cost savings have been supplied by whom? By an ERP supplier. So imagine if you were to buy ERP from me, I ask you, what would it take to convince you to buy ERP from me? And you tell me, I'm a person of business and I'll be impressed if I can get a good ARR or if I can get a good payback. So I tell you, fine, sure, let me give you some cash flows and then you can calculate ARR or payback. And obviously, since I am a vendor, I am a business selling ERP services to other businesses, I'm going to manipulate the data in such a way that it results in a favorable investment appraisal result. So you're going to get a better ARR and you're going to get a better payback because I want the data to be represented in such a manner that it lands a favorable result. So the source of the data is questionable here. Because you have contacted the ERP supplier, it is likely that he would have manipulated the data in order to win your trust, in order to win your favor. So the next thing is always in an investment appraisal question is to check the source of data. Number third, you check how dynamic is the business environment. Now, if you talk about ERP is a technology-based product. It's a tech-based product. And if you're operating in an industry where technological advances are very rapid, then it may be possible that after 3 years, perhaps a newer version of ERP can come, or your ERP might become outdated, or it may become very expensive to get it repaired by specialists because of low demand. So how dynamic is the environment? Because if the business environment is very dynamic, your cash flows may become inaccurate. Therefore, and thereby influencing the authenticity or the extent to which your calculations of investment appraisal can be completely reliable. So there's another comment. And last but not the least, it's very important to mention how will the business finance the capital cost. So if in this case, you see that the capital cost is 0.65 million or 650,000. And whenever you talk about capital cost, you're going to link it with the gearing as well. So let's say if I say that FWB takes out a loan, but taking out a loan will eventually increase your gearing. And if your gearing is increased, it's going to cost you interest. And if it's going to cost you interest, your profit margin is likely to fall. So the question is, if the business is already not doing so well in terms of profitability, will this project be feasible? Okay, fine, it has a very good ARR. Okay, fine, it may have a very good payback. But if you were to finance it through loans, sir, you are going to have a high interest payment. So we check the gearing And we can clearly see that the gearing of this business in the current year is 45%. So this is definitely going to increase, making the business more risky. Also, if you can clearly see that the profit margin has also fallen from 6.4% to 5.3%. So therefore, perhaps financing this project through loans may not be desirable because it's going to further deteriorate your profit margins as well. So these are the 4 things that you check in every investment appraisal question, because this can help you evaluate the quantitative analysis in utmost and extreme detail. So far, so good. So let's talk about ARR. Fine, the ARR that we have is 15.38%. Sir, how do I do analysis on ARR? ARR is a measure of profitability. And why would this be important for the business? Because if you talk about, I would suggest that you always compare your ARR with ROCE. So if you talk about ROCE, what does ROCE means? ROCE means considering the investment that has been made in the business, how much profit are you earning? So if ARR is concerned about an external project, if ARR tells you the rate of return from an external project, ROCE tells you the rate of return from investing in a certain business, right? And if you can clearly see that the business is not doing so well when it comes to rate of returns in the business, so the ROCE has fallen as well, and your ARR is around 15%, it's definitely higher than your current rate of return from the business. Therefore, it would be good, it would be desirable. And if you talk about payback period, so if you see the payback period, now there's always something that I would advise you to talk about. If you talk about payback period, this means that your investment would be recovered in 3 years and 9 months, right? So if your investment will be recovered in 3 years and 9 months, this means that if you take out a loan, you will only pay interest till 3 years and 9 months. And this has another meaning as well. Now, when I talk about payback period, try to compare it with the data. So let's say you invest into ERP. You're going to get profit once your investment is recovered. So your profit is going to start after 3 years and 9 months, right? So in the first year, you don't recover your investment. In the second year, you don't recover your investment. In the third year, you don't recover your investment. In the fourth year, after 9 months, you recover the investment, right? So this means that if the total project has a span of 5 years, you are only in the profitability phase for 1 year and 3 months. So payback period is very near to the useful life. And you may need to discard your ERP and may need to update your ERP. So your payback period is just like very close to your useful life. And therefore you may not be that much benefited from the implementation of ERP in this case. Also, there is another thing that I would want you to focus on. If you talk about ERP, you introduce ERP with your workers. Now your workers were used to of existing manual ways of communication, and now you tell them that fine, you need to operate this software and this is how you're going to coordinate. So they are definitely going to require some training, and it may be possible that you may also need some specialist staff to govern these procedures, since employees may take some time to settle in. So you're going to hire some specialist staff, that means recruitment, and you're going to train your existing staff, that means training cost as well. So the question arises that when you talk about cost savings, have you included the training cost and the cost of hiring or recruiting specialist staff members? The case pretty much seems to be absent regarding this information, and therefore the results of investment appraisal may not be completely reliable for us to take a decision. So this is how you evaluate any question that comes on investment appraisal. So if, for example, if I were to tell you how you're going to go on about in this answer, this is the division of assessment skills. Analysis stands for 2 marks only. That means that one chain of analysis will be enough. And in case you do not know the concept of chain of analysis or have troubles with doing analysis in your answers, I'll add the link of a very good lesson on analysis in the description. So do check out the description and view that video first. Okay, so your answer structure can be this. You discuss quantitative analysis, qualitative analysis, and then recommendation. Many students ask me, say, do we have to give a definition or not? It's completely up to you. I leave that to you, because even if you don't, you can get knowledge marks from mentioning business terms here and here. So it does not matter as such. Also, bear in mind that you're going to have 1.5 pages, because now we are given answer spaces. So your answer needs to be confined and contained to the written space that has been assigned to you. So let's talk about quantitative analysis, and it's going to be a summary of all the points that we just discussed. So we talk about payback period. We talk about how the interest is going to be paid just for 3 years and 9 months. And then we also talk about the fact that payback period is very near to the useful life of the project. So you do your chain of analysis, and likewise you talk about ARR as well. So ARR, yes, it's good. It's even higher than your ROCE, and this would be very beneficial for the business. And it also needs to improve its profitability, because the business was concerned about operational efficiency and so on and so forth. But the major chunk of your quantitative analysis might feature your detailed evaluative comments. So let's talk about evaluation. Number 1, data required was provided by the specialist himself. So why would it be true? Training cost, recruitment cost, have they been included in the appendix that has been given? Also, the greater cash flows have been recorded in the later years. The highest cash flows are recorded in year 4 and year 5. Considering it's a dynamic market, these may not be true. And then you can also talk about financing the capital cost, considering the gearing is already high. So pick evaluative comments. Minimum 2 would be enough, but I would suggest if you were to evaluate in detail as well, you can perhaps do lesser evaluation in the qualitative analysis. So in the qualitative analysis, you can talk about just in time. You can talk about evaluative comments. As you can see, this is pretty much going to be your qualitative analysis. And once you have done your qualitative analysis, I would want you to focus on the recommendation. So if, let's say for example, you talk about, okay, fine, I think that ERP should be considered by FWB, or FWB should invest into ERP, you're going to use the most important point. Many students come up to me and they tell me that, sir, eventually FWB would have to shift to ERP because of the large size of the business and the potentialities of diseconomies of scale to arise as the business would grow in size. Because if you read the case study later on, it does indicate that the business has been planning on an expansion in the international markets as well. So you're going to see the size of the business to increase, and that comes with both benefits and drawbacks. So there are chances for diseconomies of scale, and one of those diseconomies of scale is poor coordination and communication amongst departments, which can be solved by the implementation of bingo. There you go. So that can be a most important point. But then again, ERP might come with a lot of drawbacks, such as management of change, such as resistance to change from your existing employees. So how will you cope up with it? You can also mention a solution of the negative point associated with the thing that you've chosen in the recommendation. I hope this helps. Happy learning. Leave your feedback in the comments. Thank you so much.